seeing some of the older Spaces conversations on various podcast platforms, most notably Spotify. I'm going to be playing catch up on all that prior content every day, releasing 3 different episodes until we are at the present time. But thankfully, because a lot of these conversations are largely evergreen, it still ages well, as I like to say on Twitter. My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour here is Ming Zhao, who has a great following, is very knowledgeable on a lot of the dynamics internally within the markets. So I'm excited for this conversation. Ming, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, and what are you doing now?
Hey everyone, great to meet you. And Michael, thanks so much for hosting. So a little bit about me first. So I used to work at Point72 as an investment analyst and then left after a couple of years. And that was my first job out of school. Came to San Francisco and started a company and then started another company, this one currently in retail trading. And then pretty much just, along for the ride of life.
I've been trying to actually get Steve Cohen on one of these spaces because he follows me, and he's obviously one of these sort of legendary traders historically. And I know Point72's got a hell of a process to try to hire new applicants. I'm just curious, just for fun, how was that process of interviewing with Point72, and what do you think ultimately got them to hire you?
Yeah, it was pretty interesting. So at the time, they were trying this new thing. It was called the Academy Program, where they were hiring straight out of college. So traditionally, they would only hire out of investment banking. And then they realized that they didn't want someone else essentially controlling top of funnel. Essentially, they realized this was in, mid 2010. So they realized that a lot of talent was going to tech, and they wanted to take that talent back. So a lot of the interviewing process was stock pitches, in-person interview. A lot of the times was also, stock pitches, but just done, kind of like within, 2 minutes, give your elevator pitch. A lot of brain teasers. So I had to brush up on the math puzzles there. And I think overall it was a pretty smooth process, pretty fast. I don't know if, currently still is that way.
Yeah, and it's interesting to me that I don't know if this is still sort of the case for a lot of the major hedge funds, but I remember many years ago when I was thinking about shifting my career to a different part of investments, that a lot of these major firms were looking basically for the exact opposite of people that studied economics or finance. They're looking for those that might be in various liberal arts majors. And, again, you've worked with several people in Point72. I'm curious if the skill set in learning and studying markets actually becomes maybe a hindrance for how to think about markets, right? Because if we go with the idea that what you know can actually blind you to new information, because you obviously go to that which you already know, if that becomes problematic in terms of thinking about investment thesis.
Yeah, I think it's definitely not specific to markets. Of course, it's kind of like what you know in general kind of boxes you in and kind of removes your blinders for, creative thinking outside of kind of just like this track that's ahead of you. I think specifically in markets where contrarian thinking is supposed to be, the quality to look for and the way to find alpha, especially in discretionary investing. I think that this phenomenon, let's call it this like human phenomenon, is probably especially egregious. I think that because, most of discretionary investing comes from the banking track. A lot of folks are kind of, they ahead of time, they kind of go into evaluating a stock or a company a very specific way. They kind of go in and they're like, here's the multiple that's, industry standard right now. And, I need to come up with this like EBITDA metric, or I need to come up with this revenue metric and just tack on this multiple. And that's the way it's done. That's the way I'm going to do it. If I do it a different way, it could be better. I could realize different insights, but there's this agency problem, because then you realize that, but your boss is gonna, in case you're wrong, the consequences are really bad. You could lose your job, whatever. And so, that also deters people from quote unquote straying from the path.
All right. So now you mentioned that you're doing a trading startup. I saw a couple of tweets with you referring to that, and you're looking and hiring. Talk about why do a startup when it comes to trading. What is the nature of the startup, and what's your sort of end objective? What's your kind of big picture with that vision?
Yeah, certainly. So the idea is quite simple. So I got into options trading a while back. A lot of my friends got into options trading during COVID. And in regular equities, there's fractional shares to solve the problem of, several of especially tech stocks being quite expensive. But then if you try to buy an option today, you have to buy 100x or, lot size of 100. And that gets pretty pricey, especially if you're looking at like a Tesla Leap. And so what we're doing is we're fractionating options. So we're allowing folks to buy, instead of 100x, buying basically 1/100th, so representing 1x lots on options. So essentially, this would allow folks, especially beginning options traders, to say, I just want to throw $50 at a strategy. I don't want to put down thousands of dollars to hit the minimum to buy an options contract. So that's what we're working on. The big vision, obviously, is just to make markets, more accessible, especially to beginners. And then also when it comes to risk management, benefit of institutions and their size is they can afford the 100x no problem and still, hedge like their underlying securities, their underlying equities are in bundles of 100x or so small rounding error that they don't care. And so hedging is never a problem for them. But then risk managing and hedging for the average retail investor becomes very problematic when options trade in 100x.
All right, so that's actually interesting. I actually know the guy who filed the initial patent on doing fractional shares for equities fairly well. But help me out on this. So on the option side, if you're going to do that, presumably, I mean, one of the issues with options is that there's a much wider bid-ask spread, obviously, than going out and buying the direct stock or equity. So how does the fractionalization factor into liquidity in terms of that bid-ask spread? Because I guess it depends on the metric with how it's done. But I'm curious, how does that all work?
Yeah, so definitely, the options are less liquid than the underlying equities. So the way that we are thinking about it, and we haven't launched yet, is to offer a limited set of strikes and expiries precisely because of that liquidity issue. And the way we are doing it is we're essentially saying, let's call it like a minute window where you can, let's say by the time that you place the order, we have like a minute to execute it. And during that minute, whoever else, whatever other order flow that we receive is also basically put together, aggregated into a queue. And then if at the end of that minute, there's remainder up to 100, we basically come in and fill out of our own principal trading desk. So essentially, it's kind of like an Uber pool. Multiple orders for a certain security are put together in this, Uber pool, and then we join as necessary.
Okay, so that and we're going to get into market structure. I just think this is kind of an interesting discussion because I always have a lot of respect for entrepreneurs, right? But in terms of that business model, is we all know about payment for order flow. I'm going to presume that's not going to be a portion of your revenue model. But how would you go about and actually make money from this? Assuming everything's running smooth, you've got enough traders, customers. What's the revenue model there, or profit model, I should say?
Yeah, it's actually it's the same as, shares. And the way that we work is also the same as fractional shares. So in fractional shares, it's also true that the broker is essentially, joining in trades slightly different because in equities, things can print off exchange. And so the broker can basically take in an order, go in with an order, and then if the next order is smaller than what they currently have in inventory, they can just give it out in inventory. So concrete example would be, Michael, if you wanted to buy 0.2 of, Tesla stock, and let's say I'm the broker and I go in with you for 0.8, and then let's say a minute later, Alice wants to buy 0.3, and I have 0.8 in the broker inventory, I can give Alice 0.3 out of the 0.8. But you can't do that in options because everything has to print on exchange. So talking about market structure. So that means that in options world, let's say you want to buy 0.2 of, let's call it next expiring options for Tesla at the money. You would go in for 0.2. We would go in, or the broker dealer would go in for 0.8 with your 0.2. And then if Alice wanted 0.3, the broker dealer would need to go in with Alice on 0.7 again, and then therefore have, at the end of those two transactions, 1.5 contracts in their inventory. So the way, we make money, and this is up for basically, this is dependent on what happens in the markets, in the regulatory landscape, whether PFOF gets banned, et cetera. But the way we're, currently approaching it is we don't think that payment for order flow is necessarily evil. It's, it's either that or commissions. So, and essentially it comes from the same place. It's all kind of just, you pay the, couple bips of commission, or the couple bips of commission comes from the pocket of the marketer. Either way, the broker dealer kind of needs to be able to continue being alive to supply its services.
Yeah, no, very interesting. So, and we're going to touch on payment for order flow for a moment, but I want to go to the name of the space here. Stock market manipulation is everything, or everywhere rather, because it seems to me that in the last 2, 3, 4 years, as we know, especially post COVID, we went from derivatives being based off of underlying equity movement to derivatives now maybe driving equity movement. Talk about how options trading now is how it could be causing these strange structural dynamics affecting underlying equity price when fundamentals obviously are not changing.
Yeah, so one critical example that we learned through COVID was basically, gamma squeeze. And that's essentially where if retail buys a lot of calls, essentially the market maker is forced to go longer and longer on the stock, and i.e. buy more and more of the stock to do their delta hedging. And so essentially if basically that's kind of what you're describing there, like a kind of a tail wagging the dog kind of syndrome where a ton of buy pressure on the option side can cause the holders, the market makers to get into a certain position where they're not in control. So they're not constantly saying, I love this stock, I want to hold it, I'm going to buy it, but rather to delta hedge, which is kind of I don't want to say mindless exercise, but compared to a very deliberate decision, it is pretty mindless. There's a rote formula to it, and so they're being forced into this long hand that then pushes up the market.
Okay, how does that relate to terms that circulate around FinTwit, which I don't think most people fully understand, which is gamma squeeze, right? Because that seems to be often what causes a lot of these headlines around individual stocks that go vertical.
Yeah, so it's essentially, there's lots of Greeks, but when you delta hedge the gamma, which is like how much it moves or how much delta moves, essentially the second order derivative, because that's nonlinear. So that essentially that causes an acceleration in that process.
I don't know how to probably ask this without coming across accusatory to the hedge fund community, but is there a degree of coordination or the possibility for manipulation which is quote unquote legal because of social media and these kind of targeted types of moments that you hear about in the news? Because we'll touch on Bed Bath & Beyond, but I think a lot of frustration around markets and this narrative that it's all rigged is because there seem to be these legal means with which you can manipulate price for a moment in time through options.
I would say it's not necessarily an option specific thing. It's kind of like it's general to all asset classes. So I think the phenomenon that you're describing, unless I misinterpreted your question, was basically, let's say, let's take the most egregious example in crypto, and let's talk about NFTs for a sec as a slightly different illustrative class. So there's a lot of Discord channels, which, Discord channel we can generalize into all social media, FinTwit or Wall Street Bets or whatnot. Point is there are these channels where essentially someone with a lot of clout can, put on a position, and then after they put on the position can start essentially pumping it, can start, talking about how great it is and how everyone should buy after him or her. And that's apparently legal to do so. You're just talking about your thoughts about, a certain asset, and it doesn't really matter whether that asset is an NFT that you're pumping or if it's a public market stock that you're pumping or whether it's some part of their options curve that you're pumping. And is there coordination there? I think there was definitely coordination on Wall Street Bets, and it's much easier, I would say, on the retail side to, coordinate against hedge funds than for hedge funds to kind of coordinate in the reverse direction, just because there's a lot more regulation on one side than the other. But do I think there's market manipulation happening everywhere, as the title suggests? Yes, I do.
Yeah, no, and I wonder what the regulatory solution to that is, if there even is one. When you're in the business, there are certain compliance things you have to do in terms of communicating around what you're investing in. You don't have that dynamic when it comes to anything social media related. So you end up having this sort of, whether it's a whole bunch of bots that will pump a particular security or crypto, depending on how you define it as a security or not, and nobody is disclosing what their position is to begin with. So you have this kind of strange dynamic where it's easy to manipulate, send without having people actually question the motivations of the accounts that are pushing out that sentiment.
Yeah, certainly. I don't know if there's, I obviously don't know the right solution either. I'm sure everyone in the SEC is wondering that every day. But I think regulations that, obviously do help prevent manipulation, like insider trading, even though if anyone here reads Matt Levine, I feel like one common theme is kind of like, is this insider trading or is it not? And then like seemingly like every week, there's kind of something which causes you to question, what is the definition for insider trading? But certainly, that and other kind of themes in the regulatory landscape and in regulation that's already here today are, meant to kind of fence off or triangulate or limit the amount of, market manipulation.
Do you think that the regulatory bodies are just too slow to react to the way that people seemingly circumvent regulations? Because, if you're in the business, you can see a lot of this stuff, day to day, week to week, and it's almost like, well, what are the regulators waiting for to try to stop a particular type of action?
Yeah, it's definitely one of those cat and mouse games. And so naturally the mouse has to come before the cat. But I think also the amount of, red tape that's in these regulatory bodies definitely makes them slower. I think it comes down to incentives. So there's I guess viscosity and there's incentives problem. So the first being viscosity, just whenever you have more than one person, you have to vote, you have to think about, like people are incentivized in all different directions and you need to kind of streamline them all together to vote in a certain way. And it's just literally the viscosity of having to deal with hundreds of people to make a decision. And then the second part, incentives, I'm not sure. I've never worked in a regulatory body before. I'm not sure how everyone who has enough power to vote and or to sign off on things, I'm not sure what the internal incentive structures are, but there's always a way to speed things up with incentives.
All right, so Ming, I'm sharing at the top of the space here, I guess what they call the nest. You had a thread on an expose on the dark side of market structure and this idea that there's something major that the SEC is proposing that investors seemingly don't want to talk about or isn't getting any play in the media. Talk about that thread for a moment and why is what's happening with this proposal a big deal?
Yeah. So what the thread talks about and what Gensler's proposal was essentially to put all of equities, remove the way that equities are currently getting essentially processed through the pipeline. Instead of, letting dark pools exist, instead of letting internalization exist, which I'll get to in a sec, it's saying just put everything onto exchanges, essentially make equities market structure more similar to options in that everything has to print on exchange. And what that means is when things print on exchange, it allows for competition amongst all of the market makers. So essentially there's an order and then all the market makers have the opportunity to price improve on that order. So let's just say, marketable limit order for, $5 on something. The market makers can all come in and maybe one of them says, I want 4.99. One of them says, I want 4.98. And when you have competition, essentially think of it as like an auction, you can essentially get down to fair price, or that's the hope. Whereas the way equities currently works today is, imagine instead of putting, this order on auction for price improvement, instead the order just goes to one person, to one market maker, and the market maker can just, fill it at 5, whereas in the alternative universe it would have filled at 4.98. And so this is obviously just the way things are currently done disadvantages the retail investor because internalization, which is essentially, sending the order to one market maker only and not letting other market makers see or bid on it, that is essentially hurting retail. And the latest SEC proposal was to try to, reverse that and make markets more fair and open to competition.
All right, let's talk about that competition point for a moment, because I think this is at the heart of why you end up having a lot of frustration around the Citadels of the world and so forth. I don't know how much work you've done on sort of the history of market makers and how consolidation probably is why we got to this point, but why is it that competition has been so poor on the back end as far as market structure goes? And other than that proposal, what else can really be done to sort of encourage more players to make things more favorable for investors?
Yeah, so historically, let's just go back to before there were 16 exchanges. So, many, many decades ago, say when there was, only like one exchange, everyone had to connect to the exchange to trade. And with only one exchange, everything necessarily needs to print on exchange. And then at some point, I don't know which decade exactly, but there started sprouting up more and more exchanges. And then the exchanges started to differentiate. So some of them, some of them are maker taker, some of them are taker maker. All of them have different fee structures. Some of them are better for, certain sets of assets, others are for others. And then at a certain point, it just became too difficult for brokerages to connect directly to exchanges. And then it became a speed game in, like around the time of the early to mid kind of like 2010s, where at that point the brokers definitely got up, where there was an advantage to literally just have those pipes to the exchanges, and then you can essentially nab orders faster than everyone else. And then at that point in time, in order for the brokers to figure out that high frequency trading game would have been pretty impossible. And so then they said, we're just going to hand it off to someone else. And then that's kind of when market makers took on this role of, we are now the middlemen who have built out all the fancy infrastructure to connect to all 16 exchanges. And we have the ability to route your order, ideally, to have, best execution. So the fastest execution and the best price improvement. And then the brokers kind of just said, okay, cool. We don't want to do the work, or, why do the work when this other set of players in the market can do it for us? And then now there were 3 players. So then it became, orders originate at the broker, and then the introducing broker, the broker sends it to a market maker, a wholesaler to essentially route the order to the exchanges, and then the order goes to the exchanges. And so that's kind of how this middleman came about. And then, obviously the middleman is there to maximize their own utility and get as much money as possible out of this situation. And so that's kind of where market makers then, looked at exchange fees, looked at regulation, looked at kind of all of the soup of market structure, and decided, we're going to obviously have strategies and algorithms put in place to do the best for ourselves. And internalization is obviously legal in equities, and that just became, part of their optimization process.
Now, let me reset the room for the remaining 30 minutes here. First of all, everybody make sure you follow Ming Zhao here on Twitter. And I really am sincere when I say this. We should be encouraging more entrepreneurs because it's not easy to get in a space like this domain of investing from a business perspective. So always encourage people to encourage others that are trying to do something different. Again, my name is Michael Guyad.
Thanks for your question, David. So I guess first to clarify, what exactly do you mean by there is a kind of a systemic injustice? So the only difference that I can think of, and there's no, 100M minimum or threshold qualify this, is just if you trade less than 390 times a day and you're a retail trader, there are certain priority flags that are associated with your order when they go to execution venues. So one of them is called retail priority, and priority basically means that they're eligible for price improvement auctions. They're eligible for essentially greater competition, and essentially they brokers are required to meet certain best execution standards when processing these orders.
And maybe I'm wrong on this, but maybe I don't. And again, I don't know. But in your question, David, it sounds to me that, which I can see happening. Ming, you'd be closer to this than me certainly on this. But this idea that if there's information that can be manipulated in terms of emotion and sentiment, it might be from the smaller account size traders, right? Which is not a new concept. That goes back to the odd lot indicator. The idea back in the day that if you want to really see sort of where sentiment is most extreme to fade, you look at those that are trading under 100 shares, because the argument back then, whether it's accurate or not, is that if you don't have as much capital, you're not going to be as educated on markets, and then it's more about FOMO than fundamentals. I don't know if that's sort of a fair characterization of sort of the underlying question. Any thoughts on that?
Yeah, I guess there, as you mentioned before, kind of like an odd lot indicator. So there's definitely a concept called toxicity among the market makers, which is to say, what is the probability that there is significant alpha in the negative direction? So if they're forced to take the other side of a trade, what's the probability that there is alpha in said counterparty trade, and therefore negative alpha for them if they have to, take the other side? And essentially, the dealer tries to profile trading against as part of their decision on, how much to, whether they want to take side. of a trade or not, whether, if they were to facilitate the trade, how much essentially price improvement they're willing to give, because at the end of the day, the dealer is making markets, and therefore their revenue model is the bid ask spread. And so how much are they willing to essentially narrow the bid ask spread to get the order to take the other side? All of that kind of, toxicity is there. And a key component of the toxicity is, who am I trading against? And in that sense, I would say that it's a fact that, when they see a one lot order versus a large block institutional order, definitely they, append a different toxicity metric in their calculation.
So I think that's interesting, because that's I wonder if that relates to this broader observation. It's not clear if it's because of post-COVID and all the stimulus or not, but I've used this term many times on Twitter. Put out a macro piece at the lead lag report called "Uneducated Speculation Returns." I've ranted quite a bit on this idea that a lot of uneducated speculators, when it comes to not just the crypto space but the broader public markets, is the advent of fractionalization. Is it stimulus? Is it just the ease of access? What is it that is ultimately causing so many newer players that are just YOLOing into markets to do what they're doing? Because based on what you're saying on the toxicity, it seems like the big boys behind the scenes kind of want that to make money off of that uneducated speculation, which is there.
Yeah, so essentially you're asking, what is causing kind of the rise in retail traders and more kind of young folks get into the market.
Yeah, and if these institutional players actually want that, because if it goes back to that toxicity and the alpha, right? Then there's more alpha opportunities for those that, because there's more players on the smaller share size, smaller trade size side of things.
Right. Yeah, it's definitely, COVID played a big factor into it, where everyone was, sitting indoors. But I think there's also kind of a greater backdrop of just people being disenchanted with essentially with Authy and also institutions, and people just saying, like, I'm not going to just put my money into S&P 500 or into, the Vanguard ETF, because, like, who knows, like, what is Vanguard doing behind the scenes? How much of a cut are they taking, and for what? Like, are they just basically also doing uneducated investing the way that I would, or like, how much value are they adding, and why can't I just essentially, if I am going to put it into an ETF, why don't I just put all my money into an ETF myself, and then I don't have to pay the management fees to Vanguard? And so I think there's a general, like, within, just this station, there's a lot of, I would call it, contrarian thinking and questioning of institutions and disenchantment with the establishment, and just saying, like, like, maybe, like, I can figure this out, and I can do it myself cheaper or, like, better in the long run than if I just, didn't think about it, remained uneducated, and left it in the hands of Vanguard. And I think whether institutions want it to be this way or not, whether market makers want it to be this way or not, I would say that they, in general, they just want, everyone, like hedge funds, retail, pension funds, etc. They just want everyone to trade more, because at the end of the day, their revenue model comes from that bid-ask spread again. So essentially, if the market never moves, like, a theoretical experiment, so thought experiment. So if, like, the market never moves and people are trading, 1x or versus like 10x, and let's say bid-ask spread is like $1. If they trade once, the market maker pretty much makes $1. If they trade tens, the market maker makes $10, because spread gets crossed 10 times. And so really they're just incentivized for, as much trading as possible. And I would say, like, I don't think that they're able to do anything to change how much, the globally people trade. I don't think it's like, there's like some conspiracy or I don't know what conspiracy theories out there are, but I think it's just a global trend that folks are becoming more educated about financial markets. And part of that education process is, learning by doing and trying it themselves, and being like, I'm going to open up a Robinhood account and I'm just going to test it out. And I might lose some money, but as long as, I don't lose too much money, it gives me time to really learn. And then, it's kind of like people are willing to pay a certain price to learn. And then when they get better at it, the hope is obviously, I can generate alpha eventually. I know more about fundamental investing. I know more about how it's work. I know more about, how the bid-ask spread works, and, like, what a limit order is, what a market order is. And then by the time that they get there, they're kind of happy to have paid that price to learn in a sense because it wasn't too much. I think that's kind of, what I've been seeing, especially amongst like younger friends and their siblings and stuff. Yeah, certainly. I mean, the passive funds, a lot of them, ways in which, they kind of mindlessly do things that actually hurt the market. I can probably sit here all day and count my toes and name one after another. But, most egregious one is, let's call, rebalancing. So they have their rebalancing schedules, which are pretty much algorithmically encoded. And when they rebalance, it's obviously large amounts because, as you said earlier, David, they're pretty much pulling together everyone's passive funds and then they execute one large beast in the market. And so when they rebalance, which the market makers know when they're rebalancing, and that's something that, they've seen pattern, they've been like, they know, so they can definitely position themselves strategically ahead of that. They can, like buy flows if they know that rebalancing is going to cause, this giant whale to end up buying after them. They can sell flows if they know that the whale is going to end up selling. And it's for anyone who tracks these, rebalancing patterns of these large passive investors, definitely, that is an alpha strategy. Yes, that's definitely true. So all of the brokers and the market makers are forced to have what's called 605 reports, which are essentially reports that disclose EQ stats or execution quality stats. And so and these are public. So you can actually go and look through, what is TD Ameritrade's execution stats? What is Citadel giving each broker? What are Interactive Brokers EQ stats, etc. It's interesting that you said Interactive Brokers has the worst. I haven't looked at theirs recently, but I know that Interactive Brokers does things a little bit differently than the other brokers. So Interactive Brokers, I think you can choose which venue your order gets executed at. So you can essentially say, like, I want this to execute on NASDAQ, and then they will route the order to NASDAQ. They route directly to exchanges, I believe, rather than routing to market makers for price improvement. And so that might contribute to them having smaller price improvement, because by the time that their order hits the exchange, so the benefit of the middleman is the middleman can price improve aggressively because they know that it's a retail order, because it's not disguised with all other orders. Whereas if Interactive Brokers sends it straight to an exchange, all the market makers on that exchange have no idea that it's a retail order versus like an institutional order. And so, and maybe they have some models that say, oh, if it's like smaller than 5 lots, then it must be a retail order. But institutions can also, I guess shredding is the wrong term, but they can also, fragment their orders in, to look more like it's not an institutional order and look more like retail. And so I think the reason why is possibly because there's no one to say, hey, look, a low toxicity order, I'm going to aggressively price improve the way that, this happens in all the other brokers minus Interactive Brokers. Yeah, I would say I don't know how much of a difference there are between brokers on options versus equities, but there are differences, of course, and also lie with the relationship between the broker and their market making partners. So some brokers are very much EQ. They focus on certain stats in the EQ report, and other brokers focus on other stats. So if you happen to trade at a broker who very much looks and cares at price improvement, and specifically the magnitude of price improvement rather than the percentage of orders that get price improved, then ideally, basically, you want to choose that broker. Yeah, I think it's not necessarily, it's hard to tell from just that, buy orders in the 13F and then, sell order ratings. I would say that the entities that are, so hedge funds are the ones that are reporting the 13F. Sell ratings come from banks. So I'm willing to bet that they're different entities.
I think in the course it's sort of the Chinese wall, right? That happens if it's really porous or not.
Yeah. So, well, supposedly there is a Chinese wall between the asset management side and the banking side of any bulge bracket bank, any bank in general, in the US at least. I really don't think that there is, it's not worth it for the bank to sacrifice their potential reputation, to incur, tons of fines with the regulators, to just like lose all credibility entirely. It's really not worth them to have a porous Chinese wall, because that's it's so easy. Like that is not even a clever tactic. Like like they have probably so many other tactics that they can use to trade and to get alpha, and that are not, just the most glaring red flag with the regulators. I really doubt that, they're sharing information between the asset management side and the banking side secretly. I think that probably was possible like 20 years ago, like predating these Chinese wall regulations, but I really don't think, that phenomenon is happening at large anymore. I think like a related example would be if, like a short fund puts on their short position and then releases 3 days later saying like, hey, our report just came out covering, why we are bearish on this stock, and it's in the same direction. Then I think like I can see that, how that can be, interpreted as market manipulation. I think like it's just there's certainly, ways in which they're required to release the report and certain language that they're kind of required to use. But usually it would be, if someone's long, if an institution is long and they're going to say something, it's probably going to be positive. If they're short and they're going to say something, it's probably going to be negative thereafter. Usually it wouldn't make sense for someone to be long and then trash the company, because then in that case, why not just trash the company first and then buy when it's low?
Yeah, and yeah, because I do want to get to one more question before wrapping up. But it's what I would add to that is that this is why there are always more holds than sells. Part of this is the reality that these mega firms are also trying to get business, and they don't want to say to a potential client, to a whole bunch of other PMs, sell this stock, so they say hold instead. More of a side note.
So between paid users versus not paid users, I've seen certain platforms give the not paid users, or users who, if you can access an app without creating an account, what you're seeing is like 15-minute delayed quotes. I think it's true even for like Yahoo Finance, where if you're not paying for their feed, they give you 15-minute delayed quotes. If you are paying, or if you do create an account on a certain app, then you get the real time quotes. But I don't think that, I think that's like fully disclosed, and I think everyone who's using that platform should theoretically know that that's the case. And so I don't think it's manipulative behavior. I just think it's that real-time quotes are expensive, and it doesn't make sense for the business to provide real-time quotes unless a user is paying. I'm not familiar with what Coinbase is or isn't doing, so yeah, sorry about that. I don't have any, I don't use it enough, frankly, to have any things to add to your list of grievances there.
And there are many grievances we can touch on for another space. Yeah. So everybody, please make sure you follow Ming. I appreciate those that were asking questions, and hopefully we'll do another space with Ming, maybe bring in Dave Lauer and a couple others for a future conversation. Thank you, Ming, for spending the hour with us. Again, those that are here, appreciate those that joined.